Welcome back. We're heading to the pre-opening rates in just about a couple of minutes from now. So we have a few minutes to discuss some stocks. Nischal Maheshwari of Centrum Broking has been sitting by patiently. Nischal, I wanted your thoughts on some of these large cap NBFC names like, say, a Bajaj Finance. They've had a stellar run, you know, from the June lows of 5,400. Bajaj Finance is now back to close to 7,000. Do you see more upsides here purely because things are coming back in a big way? Lending has gone up. What's your thought?
I think at the moment, I think the stock seems to have peaked out. We have to understand basically that all NBFCs are bulk borrowers. And if the interest rates are going up, basically, their margins are going to get squeezed. So what I believe is basically, I think it's a good time to take away some profits on Bajaj.
All right, Nischal, thanks very much. Good speaking with you. Appreciate you joining in with that perspective. So, Nischal Maheshwari with thoughts on the market. Now, let's talk about a company which is doing extremely well. I mean, recently, I'm talking about Nelco. The stock price will come up. It was up 10% yesterday. And in the last 1 month, it is up 45%. I'm talking about month to date, it's up 45% at about 942. So what's happening? 90%, by the way, in the last 1 year, if you want to go even longer. Recent news flow is with regards to Intelsat Commercial Aviation, which has entered into an agreement with Nelco to offer in-flight connectivity in India's airspace. Through this deal, Intelsat's airline partners will have Wi-Fi when flying to, from and over India. Mr. PJ Nath is Managing Director and Chief Executive Officer at Nelco, is joining us to tell us broadly the contours of what this agreement really looks like. Mr. Nath, good to have you with us here. Thank you very much. What can you tell us a little bit more in terms of what I've already sort of mentioned with regards to this tie-up with Intelsat? What is the opportunity for Nelco here?
Okay, good morning. I think you've fairly covered it quite well in terms of the overall contours of the agreement. Let me just give a perspective. Intelsat is a global satellite operator, and they are also a service provider offering connectivity on aircrafts. Nelco is a satellite communication service provider focusing on enterprise market, the aero market, aero connectivity services, as well as maritime communication. And we use different satellites, and we are technology agnostic company. 2018 end, the government of India announced the new IFMC license, which allows the aircrafts over India, as well as maritime vessels in the Indian waters, to use satellite connectivity. And with that, the new license was created called IFMC. So we were one of the first companies to have taken the IFMC license, and we made our services operational in 2019. Since beginning of 2020, we have been offering connectivity on aircrafts over Indian skies as well. In this new agreement with Intelsat, what happens is that any of the aircrafts or the airline partners of Intelsat's commercial aviation, whenever they're flying over India, would be using the services of Nelco, which means that when the aircrafts are over Indian skies, the connectivity is offered through the services of Nelco. So that is what the agreement is, and we believe that this is an important step for both Intelsat as well as Nelco in the journey of offering reliable communication on aircraft.
Mr. Nath, can you give us some numbers on what this would mean for your business? You said that any aircraft partner of Intelsat will be using Nelco services when they're over Indian skies. How many aircraft partners do they have at the moment, and what would be the revenue contribution from this tie-up?
I would not like to go specific to that. There are certain things we would not like to disclose beyond a point, but suffice to say that the aero connectivity as well as maritime communication is a growing market, a very fast growing market for the satellite communication industry overall, globally. And the same thing will happen in India as well. So right now we are doing for the international aircraft which are flying over India. And the opportunity that we see is that as we go along, the domestic routes will also start. And that is where the bigger market will happen.
No, so Intelsat's partners are all sort of on international routes?
Yeah, so currently they have got the global airlines, and therefore the global airlines are flying all over the world. And whenever they pass over India, they will be using our service.
Okay. Could you, you said you launched this service in 2018.
So 2019 is when we got our license.
Okay.
And the connectivity we started in 2020 beginning.
2020 beginning. I mean, of course, and then there was COVID, etc. But even without Intelsat, I mean, where are your services used? Which? Yeah.
We have another partnership which we had announced in 2020 beginning in February. We are working with Panasonic Avionics, like Intelsat Commercial Aviation. Panasonic Avionics also is a Aero IFC service provider, and all the aircrafts of their partner airlines are already using our service for the last 2 years.
How are
Panasonic-
Panasonic Avionics.
Yeah.
Mr. Nath, how do you earn revenues? I mean, without going into numbers or anything. I mean, so when you tie up, is it per passenger? I mean, in terms of usage, I mean, how does this work?
See, as far as the airlines are concerned, each of the airlines have their own models in terms of how they want to price the services. Some of them will give it free, some of them will give it to the premium customers, some of them will sell per hour basis, etc., etc. Right? But because with the international aircrafts, so we don't contract directly with the international aircraft. We are contracting with Panasonic Avionics and Intelsat Commercial Aviation.
So apart from Panasonic Avionics and Intelsat, any other clients that you have on the anvil, anyone that you are in talks with currently?
As a company, we work with global partners, be it in terms of technology, be it in terms of the satellite capacity we procure, or for maritime communication services as well as aero communication services. So continuously, we are exploring multiple opportunities which are working for both the sides. So therefore, needless to say that we are obviously working on many partnerships at the moment. Having said that, I can't be disclosing anything right now. And as and when we come to some conclusion, finally we obviously announce.
Mr. Nath, my point about that, how do you make money, was about what is your agreement with Intelsat or Panasonic Avionics? I mean, how does that look like? That is what I mean. What airlines do in terms of that is, of course, but you earn, right, for the services you provided. But how do you earn?
So we earn by offering the services. We sell the services to them. The services over India, or whenever the flights are over India, there's a certain services required, right, to give the entire communication services, entire communication on the aircraft. So we price for that service.
But it's like a flat annual fee. Is it based on usage? I'm just trying to understand that. Yes.
It's a combination of both. There are certain amounts which are fixed for a contract. At the same time, as the traffic increases, the overall revenue also goes up.
How is it? What is the size in other markets where this is? I mean, just to get a sense, and what could we be looking at where this is already? It's like a mature market.
See, for India, it is not a mature market because we started the service already.
Yes, not for India, but other markets where we can kind of look at and say, well, that's where we are headed. What's the growth opportunity?
Well, see, growth opportunity will be in India. Bigger growth will happen when the domestic airlines will come. And that, I think we are about 2 years away from that at the moment.
Why is that, sir?
Because each of the aircrafts, to get them to connect on a satellite communication, we require to equip the aircrafts with respect to many of the electronics in terms of the RF, in terms of the modems, etc. And that's a time-consuming process. The provision itself takes a lot of time. Plus, the airlines, many of the airlines are already talking, but then they'll have to ultimately come up with the right business model. There are challenges in terms of the domestic route because some of the sectors are very small, some of the sectors are large, etc., etc. So therefore, overall, we believe that it will take about 1.5 to 2 years before the domestic market will start offering connectivity on the air.
Okay. Can you tell us, I mean, you're refusing to share any commercials of this Intelsat agreement, but overall for the business, what kind of growth do you see? You're sitting on about 80 crores of quarterly revenue run rate, at least as of Q1, which is a very healthy growth that you've seen. What would the average be for the full year? And by the end of FY23 and 24, what kind of growth rates are you looking at?
Well, we don't give guidance in terms of exact numbers that we'll be doing. But I had already discussed at the end of the first quarter during I think in the show itself, that our we are going well, and we expect to have, we would not be having exactly the same rate of growth of the first quarter as compared to the previous year, because there are certain on-time project revenue, but overall we are growing well. And if we see our past trends, I think that could indicate indicate where we are going right now.
All right, Mr. Nath, we'll leave it there today. Thanks a lot for joining us. That's Nifty. It's done remarkably well. It's Tata Group stock now, of course, remember. And for now, in pre-open, it's frozen at circuit. The pre-open rates are settled, by the way, even better than what the SGX Nifty told us. Maybe a lot has to do with the fact that market had preempted a decline in US and the fact that yesterday there was some resilience. The dollar index has retreated a bit. But whether the rally will sustain or not is the big question. 17,415 on the Nifty, and on Nifty Bank up about 240 points. Sudarshan, if we open here, then it's actually quite a bit away from your sort of comfort zone, would you say, or do you buy it here? And what's the 9-10 call?
No, I would buy it, but I don't have an urgency. I would be patient and look for small intraday dips or consolidation. They invariably come, but I would like to be long today in both the indices, and I'll do it. Petronet is a buy with a stop under 215.
Okay, Petronet LNG is a buy. Mitesh, your 9-10 call?
I'll go with the buy on Colgate with a stop at 1609 for targets of 1675.
Okay, a buy on Colgate. That one is up about 0.7%. In pre-opening, actually, you have the market is not bad, really, you'd have to say. And the Nifty is up about 100 odd points. Bajaj Finserv, Tata Steel, ONGC, Tech Mahindra, a couple of stocks that are in the green. But Abhishek is here. He has a brokerage report on Piramal Enterprises and all that's going to take place today onwards. Abhishek.
Well, Sonia, to begin with, CLSA has written on Piramal Enterprise. They say that, the stock is going ex-pharma from 30th August. So they revised their target price to 1,170 per share from the earlier more than 2,000 per share that they had. So Piramal shareholders will get 4 shares of Piramal Pharma. The pharma analyst at CLSA pegs the value of pharma business at about 206 per share. So they value the, NBFC business or the lending business at a price to book value of 0.8x. So this is due to the fact that medium-term ROE remains muted in the lending business, and value of investment that Piramal has in Shriram and other investment is pegged at a price to book value of 1x. Back to you.
Okay, thanks for that, Abhishek. It's very interesting where it's settled actually. Is that rate right? I'll just try to figure out. Okay, 372. Let me just try to see where that is. But Nimesh is joining us now. There was supposed to be an MSCI rebalancing, which was of course tomorrow, but tomorrow is market holiday, so it happens today, Nimesh?
That's right, Anuj. So the MSCI rebalancing will be effective today. In terms of overall India perspective, there's going to be a small weight reduction in India from 15.3 to 15.26, which will lead to an outflow of close to $300 million. So that will be effective in today's trade. In terms of sectors, the big reduction is in the technology names. So Infosys, TCS, and Mindtree all will see some selling flows around 50 to $30 million in the technology names. Some small sell flows in stocks like Reliance, $38 million, ICICI Bank, $17 million, and HDFC Limited, close to $14 million. So these stocks will see some small outflows. In terms of increase in weight and inflows, 2 stocks which will be in focus, one will be Samadram Motherson. There is going to be a buying of close to 13 million. And Adani Transmission is the other stock where there's going to be a buying of close to $12 million. Remember, in the MSCI rebalancing, there were some stocks which got migrated to the large caps, and there will be some impact on those stocks as well. So Indian hotels will see a large inflow of close to $80 million, 85 to be precise. CG Power will see an inflow of close to $60 million. There is Gujarat Fluoro, stocks like Max Healthcare will see buying between $30 to $40 million. So all the MSCI changes will be effective today because markets, India is going to have a market holiday tomorrow. So net $300 million of outflows, but there are some individual names which are going to have an impact both on the sell side and on the buy side.
Okay, thanks a lot for that and for reminding us that tomorrow is a market holiday, so midweek fun for everyone perhaps. Well, just a couple of minutes to go before the markets open. Abhishek is joining in to tell us about some auto financers and why he's watching out for them. Abhishek?
Well, JP Morgan has written a note, Sonia, over there, wherein they say that disbursements are picking up due to the pent-up demand which has returned after a 4-year stint. So higher industrial activity as well as rural recovery and positive property cycle will drive the growth ahead in terms of disbursements. So major auto financiers have seen their loan growth at around 7% per annum over the last 3 years versus FY11 to 19 CAGR of around 17%. So higher crude could impact the operator profitability. However, they believe that banks are better placed to protect margin and capture this cycle or market share in this cycle. So they expect a rotation in stock performance year to date. They have an underweight rating on Chola as well as MMFSL, neutral on Shriram Transport, while they remain overweight on IndusInd Bank. So they expect growth and ROE differential to narrow in this space, which should also narrow the valuation differentials that you are seeing between NBFCs and banks in terms of CV finances. Back to you.
Thanks, Abhishek, for that. So that's on CV financiers. Any thoughts on Chola or Shriram, Mitesh?
See, I've been tracking Chola. I think Shriram has, kind of failed to give any kind of a breakout. But Chola Finance, I think, is is on the verge of breaking into fresh all-time highs above 800 levels. And I do like that. So closing above 800 should trigger further rally in the stock, and 885 is the next target area.
Okay, 885 is the next target area. Well, let's now focus on the market opening. The first rates will start hitting us. The pre-open settled 102 points higher, which is very interesting. Okay, the first rates would begin now. The Nifty is up about 96 points, make it 102 now. So the pre-open was right. 101 now. The Bank Nifty perhaps could be a better indicator. Almost 300 points higher on the Nifty Bank. So that's looking quite good. Today is the Financial Nifty weekly options expiry. With the kind of shorts we have in the system, there could be some decent short covering in the first hour at least. In fact, the Nifty is putting some weight now. 120 higher on the Nifty and 330 higher on the Bank Nifty. So looking good over there. Bajaj Finserv is your top Nifty gainer. That's actually opening higher by about 2.5%. Then you have names like Tata Steel, Hindalco, ONGC, all these stocks doing well. Then the market's holding firm. Axis, HDFC Life, Mahindra & Mahindra, Ultratech Cement. These are all the stocks. Bajaj Finserv stands out really, 3% higher on that. Reliance is a bit soft or flattish, and Bharti Airtel is a bit down. But otherwise, it's a very, very strong sort of first trade that you have, 17,442 on the Nifty. But really the index to watch out for is Bank Nifty, which is opening 1% higher. Bajaj Finance and Bajaj Finserv, both these stocks doing well. ICICI Bank as well. Axis Bank, all these stocks doing well, Sonia.
Absolutely. We were discussing how Bajaj Finance and Finserv have come up a long way from their June lows. I mean,
yes.
In the month of June, Bajaj Finance was at sub 5,000 and now 7,000 plus in just a few months. So big moves coming into that space. The mid-cap index is also doing really well this morning, up almost about 1.5%. Lots of big movers there. Z Media, NDTV, by the way, continues to hit upper circuits, up 5% on NDTV. Zomato has been one of the strongest stocks this month. It's now up 30%. So some of the laggards are picking up. SR Shipping, a couple of these names, Z Media up almost about 5%. You have some of these smaller names, Suzlon and the likes, which are doing well. MMTC, Punjab National Bank, India Bulls Real Estate. So a lot of trading picks is what you're seeing there. Sirma SGS continues to move up post that strong listing. So keep an eye out on that. And some of the auto stocks, Samvardhan, Motherson, etc., are looking pretty good. Which are the stocks that are in the red then? By the way, from the frontliners, Reliance is just dragging its feet a tad bit. So do keep an eye out on that. And Bharti Airtel, both the telecom names actually are not performing this morning, actually underperforming the market in a big way. So do keep an eye out on that. Just wanted to also talk about some stocks that are hitting fresh 52-week highs. There's Mazgaon Dock Shipyard that's had a fabulous run of late. BEL, ITD Cementation, Max India, Indian Hotels, Hubtown, Kamath Hotels, a couple of these names hitting fresh 52-week highs. Nelco is up 5% after positive commentary from the management. That stock is up, 55% in the month of August alone. Been one of the strongest movers there. And a lot of the auto ancillaries yet again hitting new highs. Precall, Rajratan Wires, etc. all looking pretty good. Good opening for the market.
Oh, good, great opening, Sonia. I mean, given the handover overnight, I mean, the market here is just completely, almost as if the handover was different and not what we saw from US. A few other things before we move on. So we got Patanjali, which is up 3%, 12.10 or so. BLS is up 10%. That is Bombay, London, Singapore, the visa processing company. There is Adani Green, which is up 4%. Bajaj Finserv is up 4%. Vaibhav Global, it's one of those stocks which fell off a cliff, really. But yesterday was up 10%. It's up a 6% here. They basically export sort of jewelry to US, Europe, etc. There is SCI, Shipping Corporation, which is up 4%. Suvent Pharma is up 4%. Sare Gama is starting about 6% higher. But I can go down, but then volumes disappear. G Shipping starts 4% higher. I think we'll stop there. D-Link maybe, which is up about 3.5 odd as well. So these are initial rates on stocks which are doing well in the broader sphere. Bharti and Reliance both are down 0.5% each. Sirma, which is a recent listing from day before, that is down 3/4, has had a fantastic listing. And of course, listing day and yesterday it moved up, Sirma. Asian Paints is starting slightly lower as well, but very far and few in between. Market breadth, super strong for this point in the day. Just opening, first couple of minutes of trade. Our market master is Sanjeev Prasad, Managing Director and Co-Head at Kotak Institutional Equities. Sanjeev, great to have you with us here on the program as always. Thank you very much for your time. I mean, your thoughts, Sanjeev. I think you wrote a note saying, well, we're at a point where maybe earnings growth, etc., will stay strong, but perhaps also starts to taper off. But primarily, you're concerned about valuations once again. How are you looking at things at an aggregate level now, with the index being at about 17,500?
Yeah, so the issues in front of us is really valuations for the Indian market. It's already at 20 times 12 months forward. If you look at Nifty 50, EPS would be at least about 870 if you take the average for FY 24. So on a 12-month basis, already at about 20 times. So that's the issue in front of us. Can anything surprise positively? Probably looks low, I would say. Chances of earnings upgrades don't look that great in this macro environment. Chances of bond yields or inflation surprising on the downside, I would also rule out for the time being. And things go wrong on the other hand. Yes, of course, we still don't know how energy prices exactly behave in the winter months in the northern hemisphere. Presumably they will head higher. How much higher, we'll have to wait and see. And that can probably hold back the central banks from taking somewhat softer stance as far as inflation is concerned. So I don't think much will change over the next few months till the time we get more clarity on energy prices and in turn what it means for the inflation trajectory. So as of now, things look okay, I would say, for the economy. In fact, pretty decent for the economy, but I guess the view on the market is constrained simply by high valuations. Not just for the market, but if you look at on the bottom of basis for quality/growth stocks that we typically want to own in India, they are all super expensive. Whether you look at any of the consumer staples, discretionary, retailing, any of the consumption places, it's just so expensive. That's the whole challenge now.
Okay. Sanjeev, hi, good morning. We had this Reliance AGM yesterday, and they spoke about, going forward, how things will move, the succession plan as well. What's your house view on the stock? And I'm asking you because this is the biggest stock in the market.
No, we've had a positive view on the stock for some time. Fair value is about 3,000 rupees. So that doesn't change with announcements in the AGM. See, Reliance will always be, a stock where you will see there's announcements and it's clearly a growth company. So anybody looking at it, investing Reliance from a free cash flow perspective will be disappointed on the AGM news. But as I was saying, ultimately Reliance focuses on growth, and periodically you will have these big amounts of capex. So they are now getting into a new phase, which is on the 5G telecom capex, plus new investments in new energy segments. How much capex eventually we'll figure out over the next few years. But these are clearly growth areas which the company identified, and I think there are immense opportunities in the new energy vertical, and Reliance seems very well positioned to participate in that, given the fact that it has the capital, it has the technology, it has the talent to achieve all that. So if there's one entity I would like to place the bets on in terms of the whole energy transformation, which India will see over the next 2 decades. I think Reliance is very, very well placed over there.
Okay, so Reliance is all set to participate in the energy transformation of India. Yes, they have big investment plans as well, 75,000 crores over the next 5 years in their new energy vertical. By the way, the banks are just charging away right now. The bank Nifty is up almost 500 points. And Bajaj Finserv, IndusInd Bank, banks and NBFCs actually, that whole pocket. Axis Bank looking quite good. ICICI Bank in any case has been a strong stock, up 20% this year. Sanjeev, good morning. Your thoughts on financials. What is leading to such a big rally that we've seen over the last few months? And do you prefer banks over NBFCs now, or is it the other way around?
No, again, financials is something where valuations have been more reasonable compared to other growth quality stocks in the market. Look at even something like an ICICI Bank, which has been an outstanding performer over the last 2-3 years. On a 12-month forward basis, it's still about, let's say about the March 24 basis, about 2.3, 2.4 times adjusted for the value of its investment in all the subsidiaries. So it still looks like you have some more scope for re-rating over the next 12 months. Similarly, if you look at an HDFC Bank, after the merger with HDFC, again, adjusted for the value of its investment in various subsidiaries, it is available about 2.2 times by 24 basis. So I think banks, at least the tier 1 banks, still have reasonable scope for re-rating. But tier 2, tier 3 banks and BFCs, they're all actually pretty inexpensively valued as of now. Most of them would be at about 1.2, 1.3. Some of them, let's say Nifty or LIC Housing, are actually sub-1 as of now on a 12-month forward price to book basis. As of now, the situation was pretty decent for the financial names, including both banks and BFCs. I'm not differentiating too much between them, given the fact that credit quality is not an issue, at least for the next, for 24, 26 months. The rate growth should hopefully pick up as India enters into a multi-investment cycle that we're hopeful about, both on housing as well as the private capex manufacturing side. So hopefully, credit growth also starts picking up. So I don't see any real challenges for the financial names. Of course, you have pockets where valuations have become pretty expensive. Something like Bajaj Finance, 7.5 times 12-month forward price to book, outstanding company, but very, very expensive valuation. Similarly, Chola, again, very good company, about 4.5 times 12-month forward. So there are pockets where, for financial where valuation would be fairly rich. But at least, the bulk of the names, you can still make a case for them, given the macro environment they're operating in, plus the valuation looks pretty reasonable to attractive, I would say, for most of them.
Sanjeev, this is a broader question. I mean, from what I hear from you, valuations are the main challenge. I mean, otherwise things seem quite okay. Are things, and you've got a stellar research team, what do they tell you? Are in each of their sectors that they cover, companies that they talk to, is growth coming together in a very powerful way, which perhaps will lead to earnings, picking up over the course of the next couple of years? I mean, are there early indications of that? Because, I mean, generally, anecdotally, when we speak with people, that's the sense we get, that businesses are constrained for capacity. We speak with 3-4 companies, and at least 1 or 2 say we're actually adding capacity in whatever sector we are speaking about. What is your sense?
See, at least over the next 12 to 15 months, I don't see growth being too much of a challenge, because from the post-pandemic lows, especially in some of the services sector, which were very badly affected by the pandemic, you will see a fairly sharp recovery. I'm talking about essentially physical sectors such as construction, hospitality, retailing, travel, tourism, transportation, where a bulk of Indian urban poor or rural people employed. These sectors were basically decimated by COVID. So you see a fairly sharp rebound. You're already seeing that over the last 6 months, and that will continue. So I think I wouldn't be too much concerned about recovery in basic consumption items, given the fact that the segments of the population which consume basic items, consumer staples, etc., they were pretty badly affected by COVID. Plus, food prices have been, recently high. We are starting to see some inflation in food grain prices also of late. So hopefully that should support the rural, the agri part of rural India also. So I don't see growth being too much of an issue, at least over the next, let's say, 1.5, 2 years, simply based on the bound in parts of the economy. After that, we'll have to wait and see, as to how quickly does the private sector start investing. Based on all the good work the government done, we are pretty hopeful about reasonably large, investment by the private sector linked to other PLI schemes which were coming in by 525, say. And hopefully after that, India gets momentum in terms of getting into this virtual cycle of investment and consumption. And we have been talking about this. We have been pretty positive on the merchant investment side, in both housing as also private sector capex manufacturing. So hopefully all that will play out over the next 2-3 year time frame. So I don't think growth is an issue. You will see challenges in certain pockets. For example, consumer discretionary may be a bit soft for the next few quarters. But other than that, I don't see too much of an issue as far as growth is concerned in India.
Okay, since we're talking about consumption, Sanjeev, one space which has made a massive comeback is autos. All of a sudden, I mean, that's one space which is clearly in a bull market of its own now. But do you think the prices have run ahead of themselves, or is this a space where you're constructive on?
No, actually, we are somewhat negative on the auto space. More on the OEMs, I would say, we're pretty okay on the component names. But, the struggle for me on the two-wheelers is that so this is a segment which is reaching, I would say, somewhere near peak penetration. I think over the next 5-7 years, I think India will be reasonably penetrated as far as two-wheeler penetration is concerned. So I think growth will inevitably slow down over here. On top of that, you're already seeing a fair amount of disruption from electric vehicles and two-wheelers. If you look at the cost economics of EV versus nice two-wheeler, EV is already pretty competitive over there, and you have a large number of players. Presumably, the incumbents will still be large players in EVs. But if you look at the financial returns which the incumbents make, that is very, very high. So I think this is a sector which is ripe for disruption. Growth is slowing down. So I don't know whether I want to pay such high valuations for this kind of growth profile, probably declining return profile. If you look at the four-wheeler segment, essentially it's only Maruti here, to be honest with you, and it has its own set of challenges. It has lost a lot of market share in the segment which is growing, which is the SUV segment. They still continue to be very dominant in the LP segment, that is hatchback segment, but that's a segment which has actually declined significantly in terms of contribution to overall volumes. And you have a large number of very strong players now in the SUV segment. So how does Maruti make a clawback? We'll have to wait and see. The whole excitement around the auto space has been more to do with recovery in volumes, which anyway happens because volume participated in FY21, 22, and plus correction in metal prices. But I don't think that's enough for me to take a much more constructive view, at least in the two-wheelers and four-wheelers.
Just a quick word on the defense space as well. This whole aerospace and defense vertical has grown substantially. I mean, names like HAL have almost doubled this year. BEL is sitting at a fresh high. Is there more to go here?
Very hard to be honest with you. These are ultimately government companies. There is only one buyer, which is the government of India. So as an outsider, it's very hard to get a good sense of the sustainability of the earnings of these companies. On what basis the contracts are given. Whether if you look at something like a BL, look at the return profile of the company is actually very, very handsome as of now. So whether that's sustainable in the future, I'm not very clear. Clearly, your defense is a priority for India, so hopefully there will be no big change as far as the policy framework is concerned. But I don't know whether I can make that call.
Sanjeev, it's always a pleasure. Great speaking with you. Thank you very much for joining us here on CNBC-TV18 on this program. Thanks indeed. Well, the market is doing just fine. 150 higher, 17,460 is where the index is at. Futures are at about 17,500. That early week, late last week, 100-point futures premium is being cut in half. So futures are at about a 40-odd point premium on top of where spot prices are. So this is a good-looking screen this Tuesday morning. Let's focus on the healthcare and pharma space now. Ekta is standing by with a report card for the first quarter and what results and management commentary look like. Ekta, over to you.
Q1 FY23 threw up some interesting trends in the pharmaceutical and the healthcare space. While healthcare companies such as hospitals met expectations, the India generic company's performance was weak. In fact, Jefferies in their note points out that the largest miss in Q1 FY23 from pharma companies primarily was on account of US price erosion. The pressure in the US markets, combined with factors such as higher raw material prices, has resulted in margins being weighed down this time round. Companies such as Lupin, Alembic and Alchem reported some of the lowest margins ever in the quarter gone by. On the other hand, hospitals within the healthcare segment met analyst expectations. Factors such as occupancies normalizing, price hikes higher, surgical and payer mix, international flights resuming, resulted in parameters such as the average revenue per occupied bed, hence margins improving for a lot of these hospital companies. In fact, hospitals on an average saw high single to double-digit sales growth and 200 to 350 basis points improvement in margins sequentially. So, is this dichotomy in the performance expected to continue? For hospitals, analysts point out the outlook is likely to remain healthy due to factors such as headroom for occupancy to rise, along with case mix and payer profiles improving further. Whilst for generic pharma companies, the recovery is expected to be only 1 to 2 quarters away. So is the preference shifting? For some, yes. Jeffrey's pecking order now is hospitals, followed by contract drug manufacturing companies and finally generic companies. Similarly, a healthcare fund manager says their preference is all domestic focused stories, from hospitals and diagnostics to API companies, which could benefit from the China +1 factor. And yes, while US generic companies are likely to continue facing headwinds such as price pressure, input cost inflation to risks from US FDA inspections or even litigations, the advice from some is not to entirely avoid the play but to be selective. HSBC, for example, likes pharma companies that, according to them, are moving up the value chain and have near to medium-term drivers. They like stocks such as Cipla due to their pipeline of US launches and Sun Pharma on improving profitability in their specialty product sales. Lastly, while healthcare companies might be emerging as a preference, it is important to highlight the risks as well. Diagnostic companies, for example, which are a healthcare play, are seeing stiff competition, which is pulling down margins. An example was Fortis's margins being pulled lower due to their pathology arm in the quarter gone by. Similarly, investments in new verticals. For example, Apollo Hospitals increased their 24/7 investments, leading to an EBITDA loss in the division. A strategic investor, a scale-up of the arm, will be a key factor to watch out for going forward.
All right, take that. Thanks a lot for that. We have Sandhya J, who's the Group Chief Financial Officer at Narayana Health, and Prakash Agarwal, the Deputy Head Research Executive at Axis Capital, who joins in. Prakash, I want to start with you first because just from where Ekta left off, I want to take that point forward. A lot of these companies are facing margin pressures, A, because of so much competition that is coming through, and B, because of fresh investments that they're making, right? We were just speaking to the management of Kim's as well, who told us that all of these new acquisitions will result in higher costs and that will put pressure on margins. Your thoughts on how to approach this space, and what are the stocks that you still like despite the challenges?
Yeah, so as Ekta pointed out, there are clear segments which you can play with. So you have hospitals which are seeing very strong occupancy and RPOPs, which is a function of case mix, payer mix. So that is one segment which is still looking good. The second segment which we like is the domestic formulation space. Last year we saw big spike in acute heavy companies. Now we are seeing that normalization happening. So we prefer domestic companies with strong chronic portfolio, and that is our second pecking order. And thirdly, obviously the CDMO and the generics to follow. So these are the 4 key segments in that order.
Hospitals, domestic formulations, and then contract manufacturing, right?
And then the generics, yes.
And the generics last. Good to see you, Prakash. It's been a while. Thanks very much. Sandhya, good to have you with us here on the program as well. I mean, Narayana is an asset-light hospital chain. We, by the way, had the management of Kim's earlier. They made an acquisition in Maharashtra. And I put that question to them. They said, well, we like to own all our assets because, in the long run, that's better for returns on capital employed. How are things looking? I mean, how is the runway for growth looking, Sandhya, in your opinion, in the hospital space? Are things, they've been looking up for the last couple of quarters now. The big kicker, according to many, will come when, medical tourism kicks off in a big way. Could you give us some context?
Sure. Thank you for having me here. Good morning to everyone. So if you look at it, I will take first on the asset light versus asset invested model. I think I also agree that in the longer run, the return on capital is better on asset heavy or own asset model. But then we have to find the right balance because there is only finite capital available to allocate. And if there has to be a brand proliferation and we want to serve patients across, then we have to find that right balance between investment as well as asset light models. We have a mix of both. So I wouldn't say that we are predominantly asset light. A significant amount of many of our hospitals, especially in the east and south, are our own hospitals. In the newer geographies, we've gone for more asset light models. So that's on the first part of your question. The second part is from an outlook point of view. I think there are 2-3 factors at play here. Definitely because of the ups and downs of COVID, there is a certain level of demand pent up that keeps happening, and that's why hospitals see a certain spike in certain months, and then so there is some amount of catch up which is still there, which will result in the short term some amount of flow through effect to the hospital sector. The second aspect is with respect to international patients. Definitely, I think there is a good. The government is also incentivizing medical tourism. At Narayana, I think in Q1 we had our highest ever international patient traffic. Having said that, at least from our point of view, I don't know whether we will hit our pre-COVID international levels because there is a lot of the medical tourism market is controlled by intermediaries who charge a certain kickbacks or who charge certain referral fees, which is against our value systems, and because that adds the cost to the patient. So some of those arrangements we don't work with. So therefore, I do not know if as Narayana we will hit our pre-COVID highs in terms of medical tourism or international patients, but that's another area where growth will come from. And I think really one important aspect is that India as a country is very, very underserved in terms of healthcare. And now with a lot of focus coming on healthcare and
Sandhya,
getting treated, becoming more and more. Yeah.
Got it. I wanted to take that point forward because what we're also noticing is while healthcare is picking up in a big way, some of these smaller companies are finding it very hard to sustain, right? You look at it in any segment, whether it's in pathology, diagnostics, etc. There's so much consolidation happening. And as Prashant was also saying, we spoke to the management of KIMS a while back. They're looking at acquisitions as well. Is Narayana Health also looking at inorganic acquisitions? Anything on the cards in this calendar year?
So we definitely have a stated intent that we will be doing some inorganic play, especially in our Bangalore and Calcutta markets. It can be either brownfield or we could do a greenfield option as well, buy land and build. We do want to expand in Bangalore and Calcutta and in some of our, and where our return on capital is higher in terms of other markets, we will make strategic investments. So that is on the cards, but I don't think I'm in a position to share any of the work that is currently happening for obvious reasons. But definitely we have a stated intent that we will expand because we are almost nearing capacity in some of our flagship hospitals. We need more capacity, so we will build as well as we will, look at some inorganic play.
Absolutely. Prakash, since you said hospitals is right up there in terms of the different segments that you cover and what you like the most, which over not a 1 year price target kind of thing, over these management teams, the underlying value systems, and it's a sector where that also matters, right? The culture. Where will investors make the most money? Which hospital stocks you think are best suited from a 3-5 year perspective?
So we have coverage on 3 hospital names. We can talk about that. So one is Apollo Hospitals. Second one is Max Healthcare, and third is Aster DM. So all the three hospitals, we have a buy rating, and all three have different plays. So if you look at Max, it is clearly a play on expansion within their existing hospitals. So their ramp up is going to be really fast in terms of both occupancy and RPOPs. So that is one of our top picks. Whereas if you see Apollo Hospital, their new hospitals are doing extremely well. The catch-up has been very fast, and their matured hospitals are also doing very well. Where the drag is actually the 24/7, where the management has a view that going forward there is a big expansion, omni-channel presence that will happen online and offline of pharmacy. Not only pharmacy, but having diagnostic, doctor consults, etc. So it's a little longish plan, 3-5-year plan, but that is going to play out soon. And the third is Aster DM, where valuations are always on the lower side, given it has international business in the GCC area, and growth challenges are there. But then again, it is a value play in terms of the India hospital also doing pretty well. So that's why all the three are buy ideas, but all the three have different plays in that sector.
Okay. Sandhya, I wanted your thoughts on the growth that you expect going forward, because in Q1 you saw very good numbers, especially for the India operations, your highest ever margins for the India business at 16%. What kind of growth are you expecting to see for the rest of the year?
Sure. So without making any forward-looking statement, I do want to call out that we are having definitely a headspace in occupancy in some of our hospitals, and especially our new hospitals, and those are starting to build up. And so therefore, I do believe that we will be able to see some good momentum there. Secondly, in Q1, it was our Cayman operations was a bit muted, given that Cayman was going through a second wave of COVID and there were severe lockdowns. So both from a patient traffic point of view, as well as from a doctors getting quarantined, our clinical staff getting quarantined point of view, we had a muted Q1. So we will surely see recovery on that in Q2 and beyond. So that would also bring through some amount of growth for us. And like I earlier mentioned, we are looking at inorganic, organic play, and that will also give us some tailwind. So without giving an indication, at least we see the momentum to be positive.
Prakash, the other development in the space has been the Piramal demerger, right? You have some thoughts on what the pharma business should be valued at. Do you want to tell us?
Yeah, so we had a note out today itself on the Piramal demerger. So it's getting a record date, and demerge date is the 1st of September, expected to be listed by Q3, which is before December. Three businesses, CDMO, second is the critical care business and the OTC. So all the three businesses have long runway of growth. We expect them to recover from their current, currently they are facing some execution challenges given the COVID and the business is spread out across global. So we expect that recovery should happen from second half of this financial year, and going forward, there are a lot of initiatives the management has taken in terms of senior hires, in terms of capex plans that they're adding. So I think it should do well over a period of 1 to 2 years.
Okay, well, Prakash,
from a valuation perspective,
sure,
if I may just add.
Go ahead.
So our price is around 190 rupees per share of the demerged Piramal Pharma Limited. So which is, current PEL is giving 4 shares to the existing shareholders, plus there's a 20% equity that will be added for Carlyle. So the value comes about 190 bucks per share.
Okay, we'll leave it at that. Thanks a lot for joining us. Prakash and Sandhya, have a great day. That's on the healthcare space. By the way, the market is really on fire this morning. 156 points in the green on the Nifty, and a lot of stocks. The whole Adani group is having a fab day so far. Adani Green, Total Gas, Power, Adani Enterprises. All these stocks are up 3 to 6 odd %. Something like a Suven Pharma is up 6.5% today. Of course, the Bajaj twins, Bajaj Finserv, is having a dream run this morning, 5% higher. And then something like Patanjali Foods, Tube Investments doing pretty well. Let's slip into a quick break on the other side. Harshvardhan Dole of IFL, Prashant Singhal of Ernst & Young, and Harish Bijur of Harish Bijur Consults will join in to discuss the takeaways from Reliance.